Hey guys, in this module, we're going to be covering everything that has to do with liquidity. Now, to start off, let me ask you this question. Why do you think it's so important for us to have a market? Think about it, pause this video, and really think about it. Why is it important to have a market? From the perspective of companies and from the perspective of investors. So, put yourself in the company's situation. And put yourself in the investor situation. If you're an investor, why would you want to have a market? Because you'd want to be able to liquidate the stock that you had the moment you want to liquidate it at. So imagine this. Would you want to buy a house if I told you it was a good deal? You might want to. Now, imagine if I told you that you can never sell this house once you buy it because there's no market for it. Once you buy it, you're committed forever. You might change your mind, even if it's a good deal. So you need to have a market because it gives you the option to sell your asset, your product, the day you don't want it anymore. So that's why you need a market as an investor. You want there to be a market for whatever you're buying. That way, the moment you're done with it, you can get rid of it at a moment's notice without a problem. Now, there's a lot of different products that don't have a market for them. And those products are harder to sell because nobody wants to buy them and nobody wants to have them because they're scared of not being able to get rid of them when they want as well and convert them to cash. So products who have a market tend to be valued more fairly than products who don't have a value, that don't have a market. So if you're buying something that there's no market for, you might demand a discount on that product to get it for a cheaper price. That's the only way you'd be willing to buy it. So from a company's perspective, if they have a market for their stock, they know that they can value their stock at a higher price than if there's no market for it. Because if there's no market for it, people won't want to buy it. So very important for a company to have a market for their stock so they can sell more of their shares and for them to be able to sell it at a higher price. For investors, they might not want to own stocks if they cannot get rid of it when they want to get rid of it. So very important for both parties. And this brings us to the concept of liquidity. What does liquidity mean? Definition of liquidity is that it describes the degree to which an asset or security can be bought quickly or sold without affecting the asset's price. So if you can sell something quickly without affecting its price, it's considered liquid. Okay? So there's different types of liquidity. We can talk about market liquidity and asset liquidity. So when I'm talking about market liquidity, we're comparing different markets to each other. So I might say the housing market. Is the housing market liquid or illiquid compared to the stock market? Well, the housing market is more illiquid because if you sell your house quickly, you might affect the price of the house of that you're going to be selling your house at, right? You might not get the fair value. You might get a worse price because you're selling it quickly. But if you're selling your stocks, even if you sell quickly, you're not going to get something that far off from the current price. You're not going to affect the market by that much. So there's different assets that have different liquidity. Again, housing is more liquid, assets is more liquid, and then cash is the most liquid thing because it's already in cash. Now, within each asset, you have more liquid assets than not. Within each market, you have assets that are more liquid than the others. So if we go back to the housing market, if you get a condo downtown, that's pretty liquid. Because even if you want to sell 2-3 condos and on the same block fairly quickly, you're still going to sell them within the range or the price range that they should sell at. But if you have a few industrial complexes in the suburbs and you want to sell them right away, you're probably going to get a really bad price on those because the market for those is not as big as the market for condos downtown. So you're going to affect their prices by liquidating them quickly. So within each market, you actually have products that are more or less liquid than one another. Same thing in the stock market. You have stocks that are very liquid. You can go in, sell $1 million worth of shares, and you're still going to get the price where it was trading at. You're not going to affect it by much. But then you have other stocks that don't trade as much, less known, less liquid. And if you sell 100,000 worth of those stocks, the stock is going to crumble. So you really got to watch out with those ones. So you have different markets with different types of liquidity. Stock market is considered liquid, but within the stock market, you have some very liquid stocks. Facebook, Apple, all these big names. There's no issue with buying huge amounts of stock and selling huge amounts of stock. But then you have a lot of illiquid stocks, stocks that trade an average, of 50,000 shares a day. There's some stocks who trade an average of a few thousand or a few hundred shares every day. So these are very illiquid stocks. And if somebody wants to buy a lot of shares or sell a lot of shares in those stocks, they will have an impact on the price. So this is really what liquidity means. If you want to know if your stock is liquid or illiquid, all you have to do is look at the average volume of the stock. Okay? So the average volume of the stock is something that's computed usually on the last 3 months. It looks at the last 3 months that the stock has traded at and looks at how many shares the stock traded on average during those months. And it does an average of those. So if a stock has an average volume of 50,000, means it does about 50,000 shares a day. If a stock has an average of 12 million, it makes 12 million shares a day. Sometimes more, sometimes less, but on average it makes that. So you can use that as an approximation to know if your stock is fairly liquid or fairly illiquid. And that's going to conclude this module. I hope to see you in the next one.